is there, in your opinion, because, with any of these programs and in mortgage and finance and, it's not always a one size fits all.
Mhm.
Do you have an opinion as far as a reverse, who is a good fit for a reverse mortgage versus who is not a good fit? Because there might be clients who, the majority of clients this could be a great fit for, but then there might be clients who this is not a great fit for. Are there situations that you could think of that maybe it's not a great fit for, that, maybe in that situation is unique?
Yeah, that's tough. So, the typical reverse mortgage that I bump into is somebody who's living on a fixed income. They've got a mortgage payment that's between $800 to $1,400 a month, between a pension, their Social Security, and maybe they're getting a little bit of their their spouse that's passed. They're getting a little bit of that Social Security as well. So they're living on about $2,500 a month, but they're paying in excess of $800, $900, $1000, $1,200 a month in the mortgage payment. That's a perfect candidate who has a ton of equity in their home. The last 5, 6, 7 years, we've seen huge appreciation with equity. So there's a lot of people in that 62 and plus category that have got a low balance on their mortgage, and they've got a lot of equity, but they're cash strapped because they don't have a lot of monthly income. So their cash flow is very low. So a reverse mortgage in that case is fantastic. Now, you take somebody, the flip side of that is you've got somebody who's got a lot of financial instruments. They have a lot of assets. They have a lot of assets under management. They got different portfolios. For them, they go, well, gosh, why do I need to tap into my house? Why do I need to do that? Well, that's a different deal. Okay, so let's say now that person who's got $1 million, we talked about this earlier, it's got $1 million in reserves. Most financial advisors will share with you is that the maximum they want you to take from that to be smart is about 4%. Well, if you're taking $1 million and you take 4% of that, that's $40,000 per year, right? Now, that's all well and good. But if you're dipping into your portfolio in the bad years, okay, and you don't skip, meaning you've got another asset that's not correlated to the returns of your portfolio, you don't have an insurance policy against that. So for example, like this year, 2022 was a really bad year in the stock market, okay? A lot of portfolios were down by 10, 15, 20%. Well, if you took that 4% plus the 20%, you took 24% of your portfolio in 1 year. That means basically in 4 years, if we saw that consecutively, theoretically, you could run out of money. However, if you had an existing line of credit through a reverse mortgage, and you took that same 40,000, which was the equivalent of the 4% you planned on from the million that you started with, and you skipped the years when the market is down, well, first of all, you didn't reduce your balance, right? You still had the same number of shares, mutual funds, blah, blah, blah. Their value had decreased. But you were able to maintain you were able to not take that 40,000 in this case, and maybe in the next year allow it to rebound, but it's rebounding from a higher amount. That's what's really key. That's why reverse mortgages for a sophisticated investor is a complementary strategy that allows you to skip years that are bad,
right,
and pull over here that's not correlated to the returns of your other portfolio.
Yeah, and that's actually a really good point you make, because you can't make up those years that you lost.
You can't.